Bank statement loans in 2026. What changed and how not to get screwed? If you're thinking about a bank statement loan in 2026, do not make a move until you watch this entire video, because I'm going to break down what actually changed this year, and more importantly, how lenders are using these changes to qualify into payments you can't actually afford. Hi there. I'm Gurfinkel, Senior Loan Officer with almost 30 years of experience and over 2,000 families served in my lifetime. Now, don't like or subscribe until you get to the end of this video, because I don't want you to just click a button. I want you to actually get the valuable information that could save you thousands. So let's talk about what really changed with bank statement loans in 2026. First off, the HPML exemption threshold increased from $33,500 to $34,200, effective January 1st this year. Now, this sounds boring as all get up, but here's why it matters. It affects the compliance costs and process for certain loans, which trickles down to your pricing. Second, the QM points and fees caps got updated for loans over $137,958. Lenders can charge more than 3% in points and fees. But here is the kicker. The bank statement loans are typically non-QM, meaning they're not bound by these protections. So while conventional borrowers get these guardrails, you're out there without a safety net. And third, conforming loan limits went up to $832,750, and that's $26,250 higher than 2025. Sounds awesome, right? Wrong. In expensive markets, you're still getting pushed into jumbo and non-QM territory where bank statement programs live, and that's exactly where the lenders want you. Here's what nobody's telling you. Non-QM and non-QM space is expanding because Wall Street appetite for non-agency mortgage-backed securities is expected to grow about 25% to roughly $250 billion in 2026. What does that mean in plain English? When Wall Street wants more of these loans, lenders get aggressive. They add programs, they loosen overlays, and they compete harder. But guess what? You, the consumer, can get hit with more complex structures that look good on paper, but can bite you in the ass down the pike. Bank statement programs are now marketing affordability structures more aggressively. They're offering 40-year terms where available, ARMs, interest-only periods, all designed to make that monthly payment look prettier. But remember, what I always tell my clients, the lowest payment may not be the best option for you. Now let's talk about the biggest danger zone with bank statement loans, how they calculate your income. This is where borrowers get absolutely screwed, and frankly, it pisses me off. Here's how it typically works. Lenders average your deposits over 12 to 24 months, then apply what they call an expense factor, basically a haircut to estimate your usable income. Sounds reasonable, yes? Here is the problem. This process is not standardized across the lenders. Two different lenders can look at the exact same bank statements and come up with completely different qualifying incomes. I'm talking differences that can swing your buying power by tens of thousands of dollars. I've seen clients get approved for $400K with one lender and $550 with another, using the same damn statements. That's not helping you. That's setting you up to buy a house you can't actually afford because the second lender used a more aggressive expense factor. Now, here is where it gets really dangerous. Bank statement borrowers are increasingly being offered what I call affordability hacks, and they're all structural, not economic. You've got 40-year amortization that gives you a lower payment, but costs you way more in total interest. You've got interest-only periods that lower your early payment, but slow down your equity building. And you've got ARMs. They give you a lower initial rate, but future reset risk. The borrower hears, "You're approved," and doesn't internalize that the payment is low because the loan is engineered to be low today, not because the home is truly affordable. It's like going 100 miles an hour on the freeway and slowing down to 80. You're still moving fast, just at a slower clip. All right, so what do? Here is my buyer safety checklist that I give to all my clients. First, force a side-by-side comparison, same home price, compare the conventional if possible, versus bank statement non-QM. Look at the rate, the APR, points, prepayment penalty, interest only, or ARM features. Second, ask exactly how they calculated your qualifying income. 12 months versus 24 months. Business versus personal. What expense factors did they use? If they can't give you a straight answer, walk away. Third, if it's interest only or ARM, make them show you the fully indexed payment for ARM and the payment after the interest only period ends. Don't get surprised later. Fourth, confirm whether there is any prepayment penalty and its term. This is common in some non-QM channels and varies by program and state. And finally, treat the approval amount as marketing until you see the full payment lifecycle. Just because you're approved for $500 doesn't mean you should spend $500. So look, bank statement loans can be legitimate. I've helped plenty of self-employed borrowers get into homes using these programs. But 2026 is expansion mode. And when lenders get aggressive, consumers need to get smarter. Remember, approved doesn't mean affordable. Non-QM is not no doc. It's different doc. And just because the market is expanding doesn't mean every deal is good for you. So if you want honest, blunt advice about your specific situation, book a time with me. The consultation costs nothing, and I'll give you a very frank opinion about what you can and cannot do. Don't be like the people who get roped into a loan just because the payment looks good on paper. Now that you've gotten the value out of this video, if it is helpful, go ahead and like and subscribe. And let me know in the comments, have you been offered a bank statement loan? What questions do you have? I read every comment and I'll respond to you personally. Catch you in the next one.